This is what we do with clients. We show them the strategy. We provide them the content, the podcast, the YouTube videos, the free ebooks, all of the content they need. We go through their entire financial situation. We get to understand where they're at financially, where they want to go. We help them build out a strategy utilizing the infinite banking concept to help them reach their goals. And then the client ends up saying, okay, I want to do this concept. They choose what they want to do. And that's how we want to educate our clients. We never want to just push something and say, this is the best situation, trust us.
You're listening to Ecomonics, a Debutify podcast, your resource for one-of-a-kind insights into the world of e-commerce and business in the modern age. This is Joseph. I'll be presenting a wealth of industry knowledge from interviews with successful business people and our own state-of-the-art research. Your time is valuable, so let's go. Sarry Ibrahim, it is good to have you here on Ecomonics. How you doing today? How you feeling?
Hi, Joseph. Thank you so much for having me on. I appreciate it.
I'm starting to think maybe I should not ask people how they're doing before we start the recording, because I had to ask the question twice, right? It's like next guest comes on and be like, hey, nice to meet you. Like, yeah, okay, just get ready. Here we go. Switch on. Say, how's it going? How do you feeling? All right. Well, it's an ongoing testing process, but it's great to have you on. A little quick behind the scenes. It's also great because for the most part, when I fire up recordings, this is actually the first time that I get to meet people. So some of that energy flows into it. You and I have had a chance to call and just talk briefly about, what value we can offer to each other. I should have taken notes down. I don't remember taking notes down when we had that call. So a little lesson for me. But let's get you endeared to our audience. Tell us what you do. Tell us what you're up to these days.
Again, thank you for having me on the show. I really appreciate it. And it's a little bit about me. I run a company called Financial Asset Protection. It's a financial services firm located in Chicago, Illinois. We help and service clients in all 50 states. We help them with financial planning and financial services, financial counseling, and other areas that would help them financially. And I've been doing this for about 6 years now. Prior to this, I was in the Medicare space. So I was a Medicare consultant helping clients who were retiring, specifically here in Chicago, who used to work for the city of Chicago, retired, and then now are merging onto their own employer plan. Their own individually owned employee plans from their employer plan. So that was my job for a few years, helping them make that transition and building a relationship with these clients. And then I merged from Medicare into financial services. I still do Medicare, but now I've kind of combined them together. My main focus right now is financial services. I have about 4 employees now in Chicago, and the company is growing. We're super excited about it. And I want to be on, and I specifically focus on one topic called the bank on yourself concept. And that's why I want to be on your show today, to kind of share the story and this concept, the bank on yourself concept, and how it can help a lot of business owners and full-time employees.
Mm-hmm. Well, I'm certainly part of that target market as well. As one of the great things about being the host of this content is that I have no excuse in the world not to also run my own store, which I am. I haven't made any sales yet, but it's one step at a time. Mm-hmm. And I think I have the Guinness World Record for the human being with the least amount of excuses possible relative to the most amount of resources possible. So I personally want to hear about this too. If you don't mind, I do want to make a quick pit stop just on the Medicare section, because I do think it's interesting. I've always, being here in Canada, I do think it's a fascinating subject, the United States healthcare, because you have a lot of challenges. It is a first world country, and so there's an expectation that healthcare also has to be up to that. And I don't want to start taking sides, because I know there's a lot of pressure and there's a lot of blowback when people discuss it, but transitioning people from Medicare into their own employment plans, how did you land it into that particular spot?
Yeah, so before that, I was working at a company called Allstate Insurance. I was in sales and risk mitigation, and then from there, I wanted to kind of just have a different. I came across an opportunity. So this company, Blue Cross Blue Shield, had an agreement with the city of Chicago during that time. And I was able to kind of jump on that deal with a few other advisors in Chicago. And that kind of really launched my career, because the financial services part of my career came also from the Medicare part. So it was kind of like a chain cycle. It just went from one thing to another thing. It was both predictable and unpredictable. It was predictable in the sense of when you work hard and you just keep listening to people, you'll find the right things. And then unpredictable in the sense that I had no idea any of that was going to play out. So of course, there's a lot of benefits to that happening, from every side, from the Medicare side and to the financial services side. And you're right. It's pretty interesting. I think in Canada, your system is far greater than our system in the States, unfortunately. In the States, only people who are 65 and older and people who have a disability can get on Medicare. So that limits like 55 million people out of 350 million people. The rest have to get insurance through their workplace or Medicaid if they are low income, or just they're uninsured, which was a huge problem prior to the Affordable Care Act passed in 2008. So a lot of people were actually in the category, most people were actually in the category of just uninsured, and they would just sometimes pay some cash for healthcare if it was reasonable, or it would just be occurred debt and would lead to bankruptcy and other financial issues. But that's kind of the healthcare system in the United States for a really long time. I wish that Medicare was definitely for everybody. It's the same structure how it's set up for people over the age of 65. It'd be nice if it was set up that way for everybody in the country.
Mm-hmm. Well, I mean, it certainly unravels a lot of threads, which I would love to have a conversation with you about that at a different point. But it's like I said, it really is a fascinating subject. So let's bring this back to banking on yourself, and we'll put the pin back in that grenade, because I think that's how grenades work. So when I hear the premise banking on oneself, I mean, there's the literal idea of being a replacement for the institution, whereas now I'm investing money in myself. I'm my own financial asset. And I think there's also the other side of it too, is there's on a more personal level about how I would trust the bank as an institution to keep my money safe and to grow the money. One thing I did learn, by the way, from a previous guest, Matthew Pillmore, is that just putting money in the bank alone, even if it's a GIC, oftentimes it doesn't improve our financial state. What it actually does is mitigate the loss, because if I take all my money and I hide it under the bed, that money doesn't participate in the inflation. And so over time, that money will actually reduce in value. So leaving it into a financial institution is the best hope of keeping it somewhat in pace with the amount of money that's being printed. And of course, it's also the lowest risk. The higher risk, the better you have at keeping up and even surpassing it. So on the personal level, it's about investing in myself and having faith in my own long-term growth, which it certainly seems to take a little bit more of a risk. But once we know what we know about banking, it's really, there's risks no matter what we do. So get us started with the foundations and how we can unravel this and have a clear understanding and a clear takeaway.
Yeah, definitely. Yeah. And I appreciate you bringing up the foundation, because it's kind of like we want to mention, like, why are we talking about all of this? There's a reason. And you mentioned it beautifully, that there's a purpose for it, and having money just sitting in a bank account, or just sitting somewhere like not doing anything, it will actually lose you money over time because of inflation. You need your money to grow and to outpace inflation. But also, one problem that a lot of people have is it kind of, once you come across that one problem solution where I want to have my money move somewhere that's going to outpace inflation, it then stretches into a few other problems like risk, taxes, liquidity, and other risks. And to address each one, like for example, risk. To have your money sitting somewhere that's high risk could also be dangerous, because you could lose all of it. You could lose most of it. You don't know what the degree of loss could be depending on what that risk is and the time period that it takes place in. But there's also risk that can take place that could affect you. So then if the risk is so high that you lose your money, then you were better off not even investing it, which defeats the purpose of that investment. Now, another problem could be liquidity. Let's say, for example, you have the ability to save your money somewhere and to have it grow at a reasonable rate, but you can't touch it for like 40 years. That also defeats the purpose of saving your money if you can't even use it for anything else. And then, of course, taxes. Let's say, for example, you're growing your money. It's in a reasonable place. It's liquid as well, but you are taxed on every time you touch that money. That's also going to stretch into a new problem, because the volume of paying taxes over and over again, especially in the US and Canada, depending on what that type of investment vehicle could be, it could eat into your gains and profits. Again, bring it back to the first part of, did you even need to invest your money to begin with? So part of the bank on yourself strategy, it's outpacing inflation while also addressing each of those sections or categories. The section of risk, liquidity, taxes, and others.
I was just thinking, what I could do to totally like fill the remaining of the episode and coast on your explanations, just go one by one and be like, so how do we deal with the risk? How do we deal with taxes? How do we deal with liquidity? So I want to take a holistic perspective on this at first, which is this can be very discouraging for entrepreneurs because it's all just becoming an entrepreneur incurs a great deal of risk. It's not the same thing as having a systemized work flow where every day I know how much work I'm going to be doing, and the money comes in, goes into the bank. It's certainly a system set up to help some people at the current point and down the line. So, in your experience, how has this had a notable impact on people's ability to even want to become entrepreneurs in the first place? Does the entrepreneur typically understand the problems here and are factoring it into their strategy, or have you encountered a lot of people who are like, "Oh no, this is completely throwing my business off. Now my margins are all over the place, and I actually wasn't prepared for all of this." So I guess again to ask it holistically is how much damage has this done?
Yeah, it's a good question. Yeah. So speaking of like the bank on yourself concept and being able to use that in your business, it actually helps improve your business significantly because of what it could do as far as liquidity and having your money growing for you. So to kind of back up a little bit, I really want to talk about what the bank on yourself concept is to kind of give more context.
Yeah. I definitely want to hear it.
Okay. The bank on yourself concept, it's also known as the infinite banking concept, and it is the utilization of cash value whole life insurance for self-banking purposes. So for the most part, there's two types of life insurance. There's a term life insurance policy, which is like a set period of time. It's almost like you're renting the policy, its own life insurance. There's no cash value in it. That has its own functions, its own benefits. And then the other one is cash value. It's permanent life insurance. It has cash value in it, specifically whole life insurance. And as you are funding the policy, a couple of things are happening. One is that you have life insurance in the policy, just like the title of it. And the second thing is you have cash value, like a savings account inside of the policy that's growing and earning interest and dividends. So the infinite banking concept or the bank on yourself concept, it is the utilization of cash value life insurance for self-banking purposes. And that means that you are essentially funding a policy so that way you can become your own source of financing. And because of the nature of whole life insurance, specifically designed a special way, it grants you tax advantages, guaranteed growth, liquidity, guaranteed, a lot of guarantees behind it, life insurance guarantees, the tax favors behind it. There's a lot of financial benefits other than the life insurance itself behind the cash value of it. So when I keep saying, the bank on yourself concept, I'm talking about the proper utilization of cash value life insurance. And it can be applied for business owners, real estate investors, full-time employees, pretty much anybody who makes and spends money, which is essentially almost everybody on this earth. Mm-hmm. It's mostly narrowed down to people in the US and in Canada. It could sometimes work in different countries, but for the most part, it's in US and Canada. And it helps people take back control of their financial life.
Between the prior conversations that we had on the phone that I alluded to, me listening to an episode of you being a guest on a different show, and my own preparation, hearing you explain it to me now is actually the first time that it's really starting to click in my mind. Not just the effectiveness of this, but also curiously the specificity of it. Just because when we're describing life insurance, it's one policy out of numerous policies. Car insurance, you get health insurance, which we also alluded to, home insurance, fire insurance. I was trying to think of. I was just trying to think of one as a joke. Like if I could get my arms hard off, but I guess it's under life insurance. And so when you say infinite banking, I mean the dark swirl in my head is like, well, I mean, once you're dead, it's then life insurance. But as far as my perspective goes, it's infinite because it's something that I have on my plate every day until, well, it comes to fruition, which would be when the day that I pass. And it's the only policy that I can think of off the top of my head that would ascribe itself to that kind of value, because my car insurance would end if I stopped having a car. My health insurance, well, I mean, that was a little bit trickier, but health insurance plans, they tend to, from what I know, they tend to be more protracted, the further somebody is along in their life, because the expenses increase and the vulnerabilities increase. So there's a whole mess there. Home insurance obviously changes if I move to a different home, if I get an apartment. There's only one thing that's consistent across all of this, and that's life. And so to then be able to have that faith in myself and to invest in myself using life insurance, I would never in a million years would have thought this was I mean, it's hard enough talking people into life insurance. Be like, well, I'm not going to know what's going to happen after I pass, so what do I care? Like, just getting people past the cynicism is one thing. To be able to actually get a return on this while I'm also putting into it, and of course, by the way, for people wondering, there are numerous reasons why life insurance is a valuable investment. Just because it gives your family and your peace of mind for if I pass, there's going to be numerous expenses burned in on a burial, the funeral services, lawyers involved. So that's just me kind of like unpacking what you're saying right now. So let's just say, for instance, with I'm hypothetically, but not too hypothetically, I'm hovering around like a 60K figure right now. I'm not great at math, might be a little bit less than that. Where do I really start? I call up my bank and say I want to get life insurance, and then do I bring this up in the conversation with them? Is this an open conversation that I can have with them?
Awesome question.
Thank you. I worked hard on it.
So in the United States, there's about 1,200 insurance companies that sell life insurance. But the concept you're talking about, the bank on yourself concept, also known as the infinite banking concept, is a special type of life insurance. And there has to be a checklist in mind in order for you to utilize it for self-banking purposes, because that's the overall objective of it, is that for it to be self-banking, and it's for you to become your own source of financing and to replace the bankers and replace everybody else who you borrow from, so that way you can borrow from yourself. That's usually the underlying objective behind it. So in order to do that, number one, it has to be from a mutually owned insurance company, not a stock-owned insurance company. So there's two types of insurance companies. Some are mutually owned and some are stock-owned. A mutually owned insurance company is owned by its customers, by the policy owners. A stock-owned insurance company is owned by shareholders. Now, at the end of the year, when they distribute dividends, in a stock-owned company, the dividends go to the shareholders. And a mutually owned insurance company, the dividends go to the policy owners, the customers. So that's one way that you could recoup the cost of insurance is via dividends back into your policy. So it has to be a mutually owned insurance company. Number two, there has to be something called a paid up additions rider. This is called something called a paid up additions rider. It's a piece you add to the policy that helps turbocharge the cash value over time for you to have a significant amount of growth in your policy, in the cash value of your policy while you're still alive, so that way you could use that cash while you're living over and over again. That's why it's actually called the infinite banking system, is because you can constantly keep using the money over and over and over again for an infinite amount of times, even when you're still alive. So you want to make sure the paid up additions rider is in place. Number three, this is a fancy financial term. It's called non-direct recognition. What this means is, let's say, for example, you have $100,000 in the cash value life insurance policy, specifically designed this way. And let's say you want to start a business and you need $50,000 to start the business. And you go to the insurance policy, and you borrow $50,000 against it. So you take out a loan of $50,000. You're your own financing. You're self-financing. Now you're borrowing from yourself $50,000. You would leverage the cash value you have, not subtract from it. So you borrow $50,000 against the $100,000 you have. When this happens, the $100,000 that you have keeps growing and keeps earning interest and dividends, as if you've never touched that money, even when you have an outstanding loan. This allows you to grow your money and still use it at the same time, because when you're using your money, you're borrowing it from a different source. You're borrowing against your cash value. This is called non-direct recognition. And in a non-direct recognition company, the insurance company keeps paying you interest and dividends on your entire $100,000 in this example, as if you never touched that money. So in other words, whether you take out a loan or not, the money grows the same way. And that's what you need in order to be able to grow wealth over time and still be able to use it. And the fourth is, it has to be whole life insurance. It can't be any other type of life insurance. It has to be whole life. So when you take these four qualities and narrow it down from 1,200 insurance companies, it narrows it down to 4 insurance companies, which are also present in Canada. But these 4 insurance companies are the ones that we use. So in other words, if you were to just call your agent or a bank and say, hey, I want to do this whole life insurance thing and become my own source of financing, In most situations, probably 95% of situations, they wouldn't be able to help you out with this because number one, they wouldn't understand it. A lot of advisors and insurance agents don't understand this concept. And number two, even if they did, in most situations, since it only narrows it down to four insurance companies, they might not have a contract with that insurance company or might not be allowed to have a contract. So if somebody works, for example, for ABC Bank and they learn about this concept and they want to help the client, but the insurance company, for example, Lafayette Insurance Company, they can't get a contract with Lafayette Insurance Company because they're full time with ABC. There's a captive contract with them. So now they would have to steer the client away or tell the client it's not a good fit for them because it's not a good fit for the advisor or the agent. So you want to make sure that you're dealing with an advisor that understands all these things that I just mentioned, the checklist, everything, and specializes in the utilization of cash value life insurance for self-banking purposes.
It's surprising to hear that out of 1,200 insurance companies, it narrows down to four,
Mhm.
and then within each of those companies, there's only so many people who are aware of this, and it strikes me as a sign that either like you are like quantum levels ahead of the curve on this one, which wouldn't surprise me one bit, or that the industry at large is not quite up to speed with the constant developments that unfold on a day-to-day basis. Is that am I close? Is it that the insurance company or the insurance industry as a whole has not adopted this, or is it's just because like they're just I don't know, they don't listen to enough podcasts? Like why is it so difficult? This seems to me like this seems like a huge market opportunity.
Yeah.
I can't think of any human being on the planet who isn't going to die. So everybody
Yeah.
at least has some reason to consider life insurance and to know that some of that value can actually be extracted prior to in order to boost my life in the here and now, which theoretically would mean I'm going to die a lot later because my quality of life has improved. I do. Yeah, you have to excuse me. By the way, I come from like the arts background, so yeah, very liberal minded. So as soon as I get to talk about death, it's a whole gateway of humor that I don't usually get to do.
Yeah.
So what's going on with the insurance industry? Why are they kind of slow to the take on this one?
That's an awesome question,
Thank
Joseph.
you.
And I think that there's a lot of differences in place. So um, the infinite banking system, the bank on yourself concept, it might not fit the needs and wants of other insurance companies. So for example, most insurance companies are stock owned. They have shareholders, they're on the stock market, they have their own problems and opportunities that they need to solve and acquire, like more capital, stuff from government regulations. It's not really worth it for them to change up their entire system in order to cope with the infinite banking system. It's not necessary for them to do so. They're doing billions of dollars already on different types of insurance, so it's not worth it for them. That's one angle. The second angle is the insurance and financial services world is heavily, from a marketing standpoint, heavily regulated. Meaning, when you go work for a company, it's like you're joining like a cult. Like you're part, like you have to work with, that's called captive employment. You have to only represent that company. You can't represent any other company. You can't do any business. You can't give any recommendations for anything else. So what that happens is what happens then is the advisors and agents that work for these companies start to have tunnel vision, and they only focus on products that they can sell because that's their job. That's what they're supposed to do. That's what the companies want them to do. And clients come across different opportunities when clients come across different opportunities, like for example, infinite banking, they would have to figure out a way to move the client from that thinking process into their own thinking process. They would say, like, Mr. Client, the infinite banking system, I don't think is a good fit for you. You're better off putting the money in the stock market or putting the money in this mutual fund. So this way they can help them with it. Or they would just have to flat out turn them down and say, I can't help you with this. And the client would then go find somebody else that could. But of course, from a sales standpoint too, and a marketing standpoint, is that you would do whatever it takes to keep the client in your portfolio, because it costs so much money to acquire new clients. It's a big deal. The marketing behind financial services is such a big deal. So you want to do whatever it takes to keep that client. That's a huge problem in the actual industry, is that it revolves heavily around what the advisors and agents can sell and produce, and that leaves retirees and people in the hands of marketing guidelines, which should never. Those two things should never be on the same table or in the same conversation. But unfortunately, that's one huge problem. Those are some of the problems in the industry that insurance companies and financial institutions have.
Okay, so let's look at the lighter side of this as well. So of the companies that are either receptive to this, what's okay? Actually, before I do that, I wanted to stop up briefly on the stock owned versus mutually owned.
Mm-hmm.
Because mutually owned is the only viable option of the two for what we're talking about for the infinite banking, what I would say strategy or system, or however you prefer to characterize it. Let's just pretend I wasn't thinking about that for a second. Why would I be incentivized to go for a stock owned a business rather than a mutually owned? Is it because I'm profit chasing, and if they're profit chasing, then that's more like we're on the same wavelength?
So just to be clear, the question is, if you know that mutually owned is better than stock owned, why would you go to stock owned instead?
It's almost like just taking out of the infinite banking conversation for a second. Like, what is the overall appeal of a stock-owned insurance company?
So first of all, a lot of people don't know the differences, and not the differences necessarily between the two, but which companies are the differences, which companies are stock owned and which companies are mutually owned. That's one part. And the second part to it is that it might be irrelevant. Like, for example, a large company name that you see on TV or you hear on the radio, that's probably going to be a stock owned insurance company. And if you want just a regular insurance policy through them, just something to cover your death if something happens, it doesn't really make a difference at that point. It's just a commodity, and you are looking for the best rate, the cheapest rate, and then you're going to pick that company. In most situations, those companies online are on the heavily marketed and advertised are stock owned companies because they have the capital backing to do so. So it's all about a function and an objective. What is it that you want to accomplish, and how and who can help you get there? A lot of people buy stock owned companies or buy products from stock owned companies because they're well known. They've been around for like 100 years. They have solid track records. They have billions of dollars in reserves. So it makes sense to do that. But when it comes again back to the whole function objective situation, it comes down to what do you want to accomplish. And when you want to accomplish self-banking, utilizing cash value whole life insurance, then that specific function or that specific objective can only be done with a mutually owned whole life insurance policy.
Yeah, you reminded me. I don't think it's a one-to-one parallel, but it does remind me about the psychology between people who say build their own computers versus people who invest in Apple products. I've invested in Apple products in the past. I'm not innocent on this front, so I'm just trying to like point fingers or anything. But Apple products, they tend to be a larger upfront fee, but it does it's like it does commodify machines and devices so that people just focus more on what they're doing and move a lot of that, I guess, more into the they're not thinking about it. They just moved on from it. And they're just focusing on the usage of the device. Whereas I find with the PC market, and the parallel here is PC market is the parallel to the mutually owned, is that people tend to build their own computers because they know that they don't get the value of buying a PC right out of the box. So they put their own parts together, and it's a more of an upfront labor, but the understanding and the long-term value of that computer does also reflect how long they get to use it and how they're able to really maximize the value out of it. So that's just like one parallel in my head that helps me understand it. The difference between commodification versus frankly, I don't know what would be the opposite term of it.
A value, kind of also too, like if you have a passion for building computers, that Apple wouldn't be able to replace your passion for that if you want to do PC and build a PC. So that's a good parallel. Yeah.
Mm-hmm. And then to expand on that, because then we consider the difference between the entrepreneurial spirit versus what might be one who's a little bit more of a systemic creature. And I never want to castigate them because family, friends, loved ones, they're part of a systemic structure. And I'm trying to like make sure I don't be like, well, some people are trapped in the matrix, some people are out of it. It's a very difficult thing to do. But it's an effort that I take because I respect why some people need to be in a more systemic structure. They have their dependencies. Yeah. They're maybe they want to take risks, but they realize that they're awful at it, and they can only take so many risks. Whatever the case is, it's their life. But again, by going with the infinite banking strategy, it seems to appeal greatly to the entrepreneurship. For the same reason building your own computer is appealing, is because people want to see this for themselves, do this for themselves, and be more in control of their own value, whether it's a reluctance to trust a system or it's I just trust myself more than I trust another structure because I'm me and I like me versus I would just be a number or a figure to them. So there's a very broad approach here about whether or not I want to be what I want to commodify and what I don't. Right. So getting back to the other question that I had stopped myself was, so we compared why the companies, the ones that aren't participating, the reasons why, but the ones who are participating, again, this is the part that I just want to be a little more clear on. Is it seems like they're semi-aware. You have some employees who know what's going on and can be talked to about it. Some don't, so they're a little bit more up to the take now. Have you had any conversations with these insurance companies? Have you found a way to educate them on the importance of what's going on here?
That's a good question. And the answer is no, because I'm actually, like, my focus is educating clients and prospects and podcast hosts and podcast guests on this concept. The insurance companies, again, they're gonna, so somebody who runs an insurance company is probably going to know that, the ins and outs of this concept. They're going to know exactly how it works, because the utilization of this concept, the way this works, how you are leveraging your own money, like you're leveraging, you're building up an asset, borrowing against it, buying other assets, leveraging those, doing so over and over again, is exactly what banks do, insurance companies, hedge funds, private equity firms. This is exactly what they do. They build wealth and borrow against it and then keep using that over and over again. So the insurance companies are going to know exactly, like the executives and owners of the insurance company are going to know exactly how this concept works, because they do that for their own company on a daily basis. They're leveraging other assets and moving money and keeping a split in between there, a difference in between there, over and over again. So they know these concepts. They understand the financial literacy behind it. Now, as far as the focus of what I do, it's mostly concerned around educating people, because that's the most important part. If I went to every insurance company and somehow, some way convince them, okay, let's do this concept instead, and let's say they said, okay, let's do it. It doesn't mean that clients are automatically going to jump on board. We still have to go to the clients now and convince them, or not, sorry, convince them, but educate them and then have them make a decision. Because this is what we do with clients. We show them the strategy. We provide them the content, the podcast, the YouTube videos, the free ebooks, all of the content they need. And then they say, all right, I'm interested, let's talk. And then we do a financial analysis. We go through their entire financial situation. We get to understand where they're at financially, where they want to go, what their goals are, their objectives. And then we help them build out a strategy utilizing the infinite banking concept to help them reach their goals. And then from there, we show them that if you were to put it in the stock market, this is what would happen. If you were to put it in a mutual fund, this is what would happen. If you were to put it in a brokerage account, this would happen. And then the client ends up saying, okay, I want to do this concept. They choose what they want to do. And that's how we want to educate our clients. We never want to just push something and say, this is the best situation, trust us. I believe that nobody should do business in that way, where it's just you're taking somebody's word for it, especially when it's dealing with your money, your retirement, your family's wealth. You need to be able to identify the best option and then choose the best one, or even be able to connect different options together. So it's sometimes, in a lot of situations in financial planning, it's not option A or option B. It's, well, what if we do option A now, and then next year include some of option B? That's a more reasonable solution, instead of one over the other. So we help them identify these things and be able for them to make these decisions on their own.
And I think the people that you're largely helping, again, they have that underlying drive to take things into their own hands. Mm-hmm. So by the time that they sit down and they're talking with the agent, I can understand wanting to have that confidence and the knowledge of, I know what it is I'm looking for, I know what I'm asking for, and I'm just working with rather than, again, because if I'm trusting the agent to have all the knowledge, that just speaks to the larger issue of, why don't I just trust a stock-owned life insurance company? Why don't I just trust a bank? So it's very keen to see this pattern keep emerging of what is the individual going to do to take matters into their own hands, and what trust am I going to have in myself as an individual. Now, for my audience, and really, frankly, for myself too, is I would like to have some idea of like preparation, figures, as well as at what point in my career growth it might be a good time to actually start putting money into this, if not today. So let's just use this is dropshipping company. Well, technically, mm-hmm. Sort of, yeah, but mm-hmm. This is dropshipping country. So we do have, the somewhat agreed upon starting budget for somebody doing their own e-commerce business is around $1,000.
Mhm.
And while not everybody makes this next point, it's I would say it's fairly understood why it's worth making, which is you should
Mhm.
probably have some income so that you can invest that income into it. We have talked to people who just dropped everything, put everything that they got into it, but they also had the money there to do it. So one way or another, you need money to make money. Um, how much would I be? How much could I be looking at on a monthly basis to start paying into the policy, even just to get started?
That's an awesome question. And
Thank you.
it all depends. So it depends. It's not a product that just has like a fixed cost to it where everybody buys the same thing. It's something that's based off of um, your ability to save. Because one basic rule about the infinite banking concept is for the every dollar that you save into it, because and just kind of put it out there, it's a savings vehicle, not an investment. So
Okay.
for how much you can save into the system will reflect on how much you have in the later years. And of course, the more that you're able to save in your earlier years, the more tax favored wealth you'll have, and guaranteed growth you have, and protected wealth you have in the later years. Maybe we could even see a ratio of for every dollar put in, three times that amount in cash value by the time you retire in tax free retirement. So if you're allocating $1,000 a month for 20 years, you could see withdrawals or being able to take out $3,000 a month in retirement as like a pension almost, or like a pension like account where you're taking money out of it. So it all comes down to what the client needs and wants and what they're expecting or projecting for retirement. Also, it never just ends with one policy. Most of our clients have numerous policies. They take out new policies almost every year or almost every other year, so that way they have multiple streams of income in retirement plus multiple sources of liquidity, so they can go to different policies to borrow from them. To answer it more basic, the minimum that you could do a policy that we've seen and worked on is around $300 per month. There really is no maximum. It's pretty much based off of 25% of your annual income. So if you make $100,000 a year, the most you'll be able to put into the policy is $25,000 at that given time. As you start getting pay raises and start making more money, you can start allocating more money into life insurance policies, which is what a lot of people do. Is they kind of keep cycling through policies until they max them out. This way, they have that infinite growth of cash value plus the infinite liquidity they can keep accessing the policies over and over again. Again, while they're alive, they can borrow for business, borrow for job shipping, borrow for leads, borrow for Google ads, for Facebook ads. They just keep using the money over and over again out of their policies without ever interrupting the growth of it. Like, for example, one of my clients, he started with one policy and he was going to have, like, I think, $300,000 in retirement by the time he retires. And then he was like, wait a minute, what if I do 10 policies just like this over the next 10 years? So one new policy every single year as he's aging and making more money. Could I use the cash value from those policies to pay the premiums for the other policies? I'm like, absolutely. And then he's like, will that interrupt the death benefit? I'm like, no, it won't interrupt the death benefit. It won't interrupt the cash value growth. You can have multiple policies over and over again. And then he's like, so I'll have about $3 million by the time I retire, tax free. I'm like, exactly. Yes, you will. Based on these illustrations and based on the portfolio we're setting up, yeah, you have $3 million in tax free retirement. So it's a lot of different ways to access the system, a lot of different ways to fund the policies. But that's pretty much in basic. Anybody can start the policy. You could do $300 a month. You could do, $5,000 a month. It all depends on the financial analysis that we help clients with.
Well, I think that at this point, we got a really clear grasp on the subject. And I have to say personally, this is fascinating. It continues to amaze me that every time I get to talk to somebody, there is some new concept or some new really perspective or worldview to not only understand a different way to live, but to flourish. So I would definitely recommend my audience to start digging into this more. But we don't want to make any snap decisions, but are there any I'm sorry, this is a pretty elementary question, but are there any risks associated with this? Like, is there such a thing as like maybe loading myself a little bit too much money to the point where I'm not able to then repopulate the money that I had pulled out? I mean, I get some of the risk, I suppose, is like if I just spend the money poorly, right? So I can screw myself over in that way. But I just want a little bit more clarity on the relationship between the money that I'm pulling out and the money that's staying in there and the safety of which the money that's staying within the policy, or how secure that money is still is in the policy?
Yeah. So as far as market risk, there is no market risk with this because it's a savings vehicle. It's backed by an insurance company that's been in business for over 100 years. So as far as market risk, there is no market. Like for example, if you have cash value in the policy and then something happens in the stock market, with the ways that we position these policies, the cash value won't be affected by market conditions. Now, if you to your question, if you borrowed too much money and you are able to pay back, so a couple things with this. So when you borrow, you can only borrow up to 90% of the cash value. So if you have $100,000 in cash value, you can borrow any amount up to $90,000. And then when you do so, your money keeps growing. So yes, you have to pay back the loan. You want to pay it back within reasonable time. So this way you can access it again and borrow it all over again and then constantly keep doing that. Now, let's just say, for example, you took out a loan and then you never paid back the policy. Well, what would happen is that one of two things will happen. One thing that could happen is that the loan balance can keep growing. And if the loan balance reaches the amount of cash value that you have in the policy, in other words, the interest on the loan kept growing, then the policy could lapse. I kind of find that difficult because as the loan balance is increasing and how much you owe, the amount of money you have in the policy is also increasing at the same time. So I don't know how it would happen, but this is something that's disclosed that you want to pay back the loan within reasonable time because the policy can lapse if you completely ignore the loan. Another scenario that could happen, which is the more likely one, is that if you had an outstanding loan and then in the future you pass away, let's say, for example, you have $100,000 in cash value, you have $1 million in death benefit, you borrow $50,000, you wait a really long time to pay it back, you end up not paying it back, but you pass away, your beneficiaries would get $1 million minus the outstanding loan balance, let's say $50,000, they would get $950,000. That's the more reasonable or more accurate one. The first one is a little bit subjective. It depends on the insurance company, it depends on the dividends, the interest that's paid out, other factors. But the second one is more likely to happen.
I guess it's possible that there would be a third outcome, which is if I don't pay back my own loans, I might send somebody to my own house to break my own legs.
Yeah, since you're your own banker, you could do something. You could do stuff like that.
I wouldn't put it out of the question. I've been my own boss before, and I've had some internal fights. So again, I'm just gonna start soaking this in and let this sink in, because I think this is an interesting concept for sure. When you say that at the lowest end, $300 is a pretty reasonable amount of money to put away. I don't need to give away all my financials, but I usually deposit about that amount of money right now to to my bank, frankly. So we'll with the time that I have left, there is something else that stuck out that I thought might be fun to unravel here, because you said this term before, and I hadn't heard anybody use this term before, which is captive employment. Now, my spider sense says some of that might have had to do with personal experience, and I guess I just want to hear about, like, when did this concept come to you, and maybe when did you see it realized, or like when did you see like real world examples of it manifesting? Because we can be introduced to the concept, and it might be something that explains something that we've experienced in the past, or maybe you saw the concept and then something happened in the future to tie it together. So I'd like to hear your backstory on your use of this term.
Yeah, and this is an official term. I just kind of like made it up. It has it's based off of, like, for example, a lot of financial advisors and insurance agents are either independent or captive. If they're independent, they could represent different insurance companies and financial institutions. Like, they can represent like 50 or 60 insurance companies or financial institutions. They can also do different things. Like, for example, an independent advisor can also partner with a mortgage lender or a real estate agent, and they can have a shared office and then do joint work together where you refer a client to them. They could do a refinance and then also do the funding of a whole life policy. You could do stuff like that when you're independent. When you're captive, it's not necessarily, it could be employment where you work for a company, you're a W-2 employee. You go to, for example, ABC Insurance Company. You have to be there, set hours. Like other W-2 jobs, you can only sell ABC Insurance Company and only represent them. You would wear their logo, have their business cards, their website, everything would revolve around ABC. That's the only products you would represent. And then there's even self-employment where you're captive still, where you can open up your own business. This is kind of like a franchising model where you're a self-employed, you're your own business owner, but you have to follow the rules of the company you're affiliated with. You have to only wear, have their polos, their shirts, their pens, their business cards, their everything has to be with that company. You can only do business with that company. You can't do any outside work unless they approve it. So like, let's say, for example, you did find an insurance, a real estate broker or a mortgage broker. They wanted to send you business and you could do some sort of joint work together. The company you're part of has to approve that before you could do that. And if you don't, you can lose your contract. You get terminated actually if you don't do that. So long story short, there's two sides. So there's independent and captive. I was a captive employee. I used to work for Allstate Insurance, and I worked for a couple other companies as a captive employee, and then became an independent business owner. So independent in the sense of I actually represent right now like 20 insurance companies. I have current contracts with them on the Medicare side and on the financial planning side. And I could also, and I'm self-employed too. And I could also, like, I have some joint agreements right now with like real estate investors. So I could do these different things. So that's kind of like the history behind it. I prefer to be, a lot of people would argue and say, well, captive could be better because you have a set structure. Everything is given to you. The website is given to you. The logo is given to you. Sometimes clients are given to you. Everything is handed to you. All you have to do is just show up to work and just like handle everything. But I like the rush of being independent because independent, everything is completely on your own, from the CRM that you use, the client relation manager system that you use, the logo that you have, the name of the company, the website you have, every single thing is on you, which obviously makes it 10 times harder, but also it's far more flexible and a lot more, and more importantly than all of this, more importantly than personal preferences, it's far greater for the client. Because if a client comes to me and says, hey, I got a brochure from this insurance company, it looks really good, I could actually look into it for them as an independent agent. And let's just say it is a really good deal, like they have a really good product, for example, I can reach out to the insurance company, get a contract with them, and close that deal for the client. In other words, I'm working for the client. I can go out and do these different strategies for clients without any restrictions at all. On the captive side, you can't do that. You would have to, again, you'd have to tell the client that's not possible, or tell them our product is much better than that product. And you have to do whatever it takes to keep the client in the pipeline.
Right. And it can be difficult because if I'm sitting across, let's just say I'm the agent, I'm under captive employment, and I'm speaking to somebody, and I have to weigh numerous pressures. There's a pressure of servicing my company mm-hmm. because they are paying me and they're giving me sustainability. But mm-hmm. I'm also trying to look out for the well-being of the person sitting across from me, because that's mm-hmm. the person that I'm connected with in that moment. Mm-hmm. And there are a lot of approaches to it. One approach would be, if I'm going to work for this company, I have to really believe in what it is that they're selling, which mm-hmm. does tend to improve productivity. Mm-hmm. I might add. And I guess it stuck out to me because in a lot of what we talked about here, we can go pretty broad and take a holistic view of it. Is that that it's another way of looking at what I was referring to earlier about systemic structure, or being part mm-hmm. of a part of an employment system where you have your set hours. And full disclosure, that's the position that I'm in now, right? I still have my freelancing. I've experienced independence, and mm-hmm. my personal perspective is that I think entrepreneurship is this energy, or is this force that really calls people to join them. Mm-hmm. People are compelled to become entrepreneurs for different reasons. And so I think for them to be part of a systemized work environment, mm-hmm. it's all for the learning. Mm-hmm. It's much better to know how all these things work. So that way, when I jump into entrepreneurship, I'm not inundated with trying to understand what I'm doing, as mm-hmm. well as trying to make the business functional, if not profitable. Mm-hmm. And I was listening to another one of your podcasts, and by the way, you have this really cool playlist where you show up like all of your different appearances. I've had my personal YouTube channel for like 10 years, and I thought, why didn't I do that sooner? Anyways, and one of them that you talked about is like you've had experiences where you're being paid, and while you're being paid, you were learning so much mm-hmm. that looking back on it, you would have paid money to learn what you learned mm-hmm. at that point. Mm-hmm. So. I think for one way to characterize this for entrepreneurs is let's just say that they're in a captive employment situation. They're part of a structure. For the time being, what would be the ideal system for them to be a part of before they can break free and join the entrepreneur world?
Yeah, and just so I understand the question correctly, it's which route would be better for them to start off in?
If Okay, a little more specific. If somebody starts off in a captive employment scenario, what's
Yeah.
the best way to get the most value out of it?
Oh, okay, gotcha. Okay, perfect. Yeah. So if you're captive, the best thing to do is go all in with those few products that the insurance company or the financial institution has. So that's also a good thing too. That's a good point. Is that sometimes it's better if so. Let's say, for example, you work with one company and then you only have like two products. That's it, just one company and two products. That can also be a really good thing too, because what if you have thousands of customers coming in? You could just screen them or have a screener, and then if they want that product or are looking for that, you help them. If not, you just chop them off and keep going. And that could be a good thing too in business and in marketing, because you're getting super good at a very finite thing to do. It's very predictable. You could see your wealth increase that way. That's actually a very smart thing to do in business. Is just kind of narrow something down and get really good at it. And then if you wanted to kind of course, do more things, then the independent route would be better. Like it would be better then, because here's the thing. Let's say, for example, somebody in California wants to do an investment project with me, and then somebody in New York wants to do this whole life product. And then somebody in Florida wants to invest in real estate. I could connect everybody together on Zoom and figure this whole thing out as an independent broker, an independent advisor. Captive, you can't do things like that unless you have outside approval. So if you want to just laser focus on just a few products, captive would be perfect for that, including if you had to turn away clients, it'd be perfect for that. Whereas independent, I think is more exploratory. It's more visionary. It's like if you want to do more things, it's far more difficult. But that's kind of like the biggest differences between being independent and captive.
Oh, a great way to summarize it. So I know we gotta get you on out of here. There was one other thing that I was intrigued about looking into some of your background. I'd love to ask you a quick question about it, if it's all right. If not, we'll exit. Because I know that you were a civil rights intern earlier on in your career, and I don't get to really talk about that very much at all, and not just on the show, but just really altogether. And I would like to know if you can tell us about any like standout experiences or lessons that stuck out to you from your time in that position.
Yeah, so that was I was gonna go to law school. I was a junior or senior in college, I can't remember, and I was gonna go to law school. So I wanted to get like an internship and for a law firm or a civil rights organization, and then go to law school. And then I ended up didn't go to law school. I ended up getting my MBA instead. But during that time, it was really interesting because it was like a civil rights organization that helped people who are like discriminated against. Like if somebody worked at a company or like I don't know. Yeah, it was mostly employment related discrimination. Um, I would be the first person, like the kind of the screener. Like I would talk to them and then take notes, and then we'd have like a daily meeting with the lawyer, and I would tell the lawyer like, yeah, this person called, they're having this issue, and the lawyer would be like, okay, call them back and ask them these three questions. And if the answer is no to them, then skip it. If the answer is yes, then forward it over to me, and then I'll give them a call. So I was like a screener for it, and it was a lot of good experience because it was like we see obviously not that much legal experience, but the basics of it, of how the funnel comes in, how people reach out for help. One thing I learned is that um, there's a lot. Humans are very problematic. A lot of problems happen, and whether it's workplace, whether it's discrimination, whether it's racism, whatever the situation is that happens, um, you obviously can't take it personally, and this kind of goes to a little off topic, but I'm really proud to live in a country where we have these organizations, we have people who will listen and stop people from being racist, from discriminating against other people. That's something I'm very proud of. It's something that I kind of want to go back to later in my career. I want to start a not-for-profit organization where I help people in poverty with free financial counseling, free financial literacy, to kind of help people who don't have they have the same rights, of course, but not the same privileges or the same standards as other people. So this is something I take very personally. This is why I wanted to be a lawyer, but ended up didn't. I ended up getting an MBA Who knows? I might go back to law school. I don't know. But that was a one chapter in my life.
Well, I think between your work in the Medicare field and in civil rights and what you're doing now is I certainly see a lot of light here, which is you really want to help people in different capacities, because people need help in the workplace. They need help with their own health. They need help with their own freedom. And so that's just like a lot that I had to say that I really admire about who you are and what you're doing. So it's to summarize and to kind of like cap off this episode. Really was great to meet you and to talk to you at length here, and just to the takeaway that I'm having is substantial and is really sinking in. So I just if I can more eloquently express my gratitude, I would, but that'll have to do, I'm afraid.
Yeah, you too, Joseph. Thank you so much for having me on.
Terrific. So the last thing to do before we get you on out of here is to, usually if you have any like parting words, if there's like a proverb you like, something like that, you're free to express it, and then let the audience know in what way they can perhaps reach out to you or have a look at some of your content.
Yeah, so a lot of the material we talked about earlier on the financial side, it involves thinking like a bank. It's doing something that banks do, and this is actually ironically why we made our podcast. Our podcast is called Thinking Like a Bank, so check that out. And I'm a big fan of books, and I'd like to give away a free copy of a book called Becoming Your Own Banker by Nelson Nash. It's a book that explains the infinite banking system in detail, and I'll give it away to you for free if you reach out to via online our website. It's finassetsprotection.com, FIN assetprotection.com. There'll be a link for the free book. You could download it, and then also reach out to us if you have any questions.
Excellent. And with that, to our audience, I certainly hope that you all had a great takeaway today too. So there's certainly a lot to think about and a lot to talk about. So all the best to you, and all the best once more to our guest, Sarry Ibrahim. And with that, take care. We'll check in soon.
Products, and at the end, I did find a product that was, I wouldn't say like wildly successful or anything, but at least I was.
Hey, this is Joseph from Ecommerce. Just wanted to thank you for being here and for giving this content your time and attention. I hope you learned something. I can say with certainty, I have learned something with every episode that I have done, and I don't see that changing anytime soon. There's a couple things you can do to help us out. If you want to check out the audio content, we are available on all major podcast platform distributors. And while you're there, give us a 5-star review. It helps a lot. And while you're here on YouTube, there's a lot of things you can do to help out as well. It's not going to take very long. Subscribe to the channel, hit the like button for this episode, and hit the notification bell so when we have new content for you, it's going to be at your doorstep ASAP. Lastly, this podcast is created by Debutify, the best Shopify template available. It is 100% free for you to start, and it can change your life. It can make you so much more free than you are right now. So if this episode wasn't enough to convince you, I think a few more might do the trick. So have at it.